Santander is out with a new survey on how inflation, interest rates, and housing costs are impacting its 750,000 middle-income banking customers. That's defined as households making between $50,000 and $148,000 a year. Joining us now with the exclusive details is Tim Wennes, the CEO of Santander US. And a lot of people are out there thinking a lot about how higher interest rates are impacting the consumer. Where is the consumer starting to break? What does the data show you?
First, I'd say, Sonali, that consumers remain optimistic and resilient. Right? You still have 3 in 4 Americans who feel like they're on the right path to financial prosperity. And we've seen a lower percentage of people, about 20%, who are feeling insecure about their financial future. But 90% of consumers are cutting back on expenditures to handle unexpected things and higher prices driven by inflation.
Well, what was staggering about this survey as well is even if you have some optimism baked in there, you have more and more Americans that are looking for that second job to really be able to pay their bills at this form in time. There's a lot of people saying inflation is abating, but your survey still shows strains.
That 3 in 4 of the consumers we surveyed this quarter said they saw prices continuing to increase, particularly focused in key areas, groceries, at the gas pump, and utilities. And 90% are cutting back on expenditures, so that's still substantive. And we also saw the majority saying that they're planning to spend less on vacations and travel and leisure this summer.
What does this all say to you as somebody who runs a massive U.S. bank on how the consumer may look to the credit markets in the future?
I do think that the consumer, they're making the adjustments to higher inflation. The thing that was most surprising to me is over 40% of middle-income Americans surveyed said they took a second job in the last 12 months, either with the gig economy or something, to help pay their bills. So it tells us that with high prices, we should continue to see the economy slow. We had 28% of those surveyed say that they've put off purchasing a new home in the last 12 months because of affordability issues, and 55% have put off purchasing a new car. So there is some pent-up demand, but people are struggling with respect to being able to acquire the things that they need or want for their financial prosperity.
How do you think about that last part of the equation? You're a major auto lender as well, and if people are putting off the ability to buy cars, how do you think about how their behavior may look moving forward?
I think people are working hard to stay in their cars. And so while we've seen a normalization in terms of delinquency rates, we're at pre-pandemic levels in our auto business. We're seeing lower loss rates as people may fall 30 days behind, but then they're juggling payments. They're finding a way to make that payment because they need that car in order to preserve the job and in order to get to work on a daily basis. That being said, I also think we're going to see used car prices be relatively resilient because with half the people saying they've put off purchasing a car, 45% say they intend to purchase a car in the next 12 months.
Tim, how do you see the housing part of the equation working out? If you have so many of your customers telling you that they can't afford a home, at what point do they figure out how to make that part of their equation? Do they start to let go of that American dream?
One of the other surprising factors for me in the survey this quarter was that the majority, more than 50%, said that they did not believe home ownership was required for their financial prosperity. That's a big change from conventional wisdom and conventional thinking here in the past 5, 10, 15, 20 years.
It's a massive change. And if that's the truth, then where else are they spending their money instead?
Yeah, well, we've also seen rents rise, but also we've seen a pretty healthy savings rate. There's been a lot of discussion around people spending down those pandemic savings. And our survey said that people are still continuing to add incrementally to their savings and are feeling relatively stable about that. My only other comment there is we still had a survey that 20% of consumers they weren't aware of the rate that they were earning on their interest rate. And one of the benefits of higher inflation is higher interest rates and higher interest that you can earn on your savings. And so more people could be taking advantage of that. We still have seen 60% of the people haven't taken advantage of moving their money to a higher rate savings account or certificate of deposit.
Well, it's pretty incredible. Do you think that many Americans might miss that opportunity?
I think that this would say that 60% are. And those who do know their rate, 50% were earning less than 3%. which, right, if they looked around, they could find a certificate of deposit or high-yield savings account that could yield more than that.
How do you think about this also back to how you run your bank? You're getting all of this information about where people are moving money. We're in the precipice of a potential interest rate cut later this year. How do you take the information you're getting in and positioning so that you're meeting the new needs of these consumers?
We do this in terms of us trying to make sure that we're making our consumers aware of the higher rates of interest that they can earn on this savings that they've worked so hard for. Yeah, in terms of certificates of deposit or high yield savings. And then also just being really thoughtful in terms of the lending side and making sure that we've got options out there for as many consumers as possible.
Where do you worry the most, Tim? Do you think that one potential rate cut can start to ease a lot of these strains that consumers are feeling on the credit side?
I think it can. I worry on the geopolitical front that there could be some other surprise or something else that impacts the economy in some way that's unexpected today.
Tim, we thank you so much. That is Tim Wennes, the U.S. CEO of Santander, of course, on a highly watched corner of the market.